So we're at the Business Insider, and it talks about Arthur Laffer, who worked in the Reagan administration. And there's this headline: "I was wrong about inflation and the Fed." Okay? And if you guys don't know, he is the guy who promotes the Laffer curve, where it pretty much says you lower taxes, you get more productivity and more revenues. I agree with that philosophy. And let's just see what he wrote about inflation in 2009. And in June of 2009, he penned an op-ed warning excessive quantitative easing would eventually lead to higher inflation and interest rates. We haven't seen anything like this in the US to date, or in the US. To date, what's happened is potentially far more inflationary than were the monetary policies in the 1970s. When the prime interest rate peaked at 21.5%, inflation peaked in the low double digits. Gold prices went from $35 an ounce to $850 an ounce. The dollar collapsed on the foreign exchanges. It wasn't a pretty picture. Obviously, nothing like that has happened. That's what the author of this article is saying. Sure, it hasn't happened, but what happens when the banks start lending this money out? Remember, the Federal Reserve has increased the money supply over 33%. And the definition of inflation is the increase in money supply and credit. And then what happens when banks start lending? What happens if you have an economic boom? This money is going to go somewhere unless you get a deflationary crash before the tax cuts that come in the future. So those are my thoughts on this, but let's just see what else he wrote. Usually when you find the model this far off, you've probably got something wrong with the model. Not that the world has changed, he said. Inflation does not appear to be monetary base driven, he said. I don't quite agree with what Laffer is saying. We have plenty of inflation, and that's in the stock market right now. And if you look at the way that the inflation is created, it's not including, suppose you're getting a smaller packaging size. If you're getting a smaller packaging size and you're paying the same, that's inflation, but the government's not calculating that. So what the Business Insider and Art Laffer fail to admit is that the government is managing expectations by manipulating and rigging the CPI numbers, which I will get into later on. And then it goes on the article. He's totally not comfortable with what the Fed is doing, however. Ask me whether inflation represents a longer-term problem. I think there's a potential for excess reserves to create problems, but it now seems impossible to predict. So let's just get this straight. We have the Business Insider, which is a propaganda outlet, and they don't understand what inflation is, or they fail to acknowledge what inflation is, which I stated before. An increase in money supply and credit. And people don't understand this, and I will show people that they are simply, or the mainstream media is simply clueless when it comes to what the definition of inflation is. Okay, and I mentioned part of the definition of inflation is the increase in money supply. Here, look at M2. Look at the M2 since 2009. It's going up. That's inflation. Pure and simple. And over here, this is the total credit market debt out. As you can see here in 2009, when we started this credit crunch, right, or when we're in the later stages of the credit crunch, the total credit market debt outstanding is $53 trillion. Now let's look at quarter 3 2013. Total credit market debt outstanding is $58 trillion. So we've seen an increase from $53 trillion to $58 trillion. And sure, a lot of it has gone to government borrowing. But at the end of the day, inflation is defined as the increase in money supply, which we're seeing an increase in money supply and credit. We're seeing an increase in credit. Sure, it's not it's not expanding to the extent that it used to before 2009. I think some figures after World War II to 2007-ish is growing at 8.8% a year. And it's not growing at 8.8% a year. So you could say that this is a form of disinflation. But to say that we're experiencing deflation right now, no. You could say in the credit markets in 2008, I don't have the data in front of me, you did have a contraction of the credit. So you could call that in 2008 partially deflationary, but you have to call it inflationary when it comes to the increase in money supply. So this is something that mainstream pundits will not acknowledge. Now, getting back to people and those who are denial about inflation, I mentioned this one individual, Rob Willie at the Business Insider. He's completely in denial when it comes to inflation. And you want to look at another individual, it's Larry Kudlow, right? Larry Kudlow makes a stunning admission about changing his mind on Bernanke. It's by Joe Wiesenthal, hardcore leftist. Once again, he doesn't understand basic economics. Let's just go through this article, and he says, throughout the economic crisis, Kudlow criticized the lax policies of Bernanke. And this is what Kudlow said. Mr. Bernanke just doesn't get that inflation-sensitive market price indicators like rising gold, oil, and commodity indexes and the falling dollar exchange rate are trying to signal higher future inflation. Instead of listening to markets, he is determined to fight them. This is a losing battle. Instead of a market price rule, we have some sort of Bernanke fine-tuning rule. It's not working. And it's not working, he's clearly right, the old Larry Kudlow, because that inflation is going to the stock market and distorting asset prices there. And this recovery has been phony. But then all of a sudden, Kudlow made a stunning admission last year, or probably 10 months ago. And in the National Review, Kudlow makes a stunning admission. Ben Bernanke might have been right all along. And Kudlow talks about market monetarists and Milton Friedman, who were actually in support of all this money printing, or who would probably be in support. But the thing is that we see all of these, how should I say it, academics or mainstream outlets, they're in total denial about inflation. They're saying that we have inflation around 1%. Bogus. MIT's Billion Price Index said it's at least 1% higher, and that's not even including the packaging sizes that are getting smaller. So they're clearly cooking the books there, and they're not acknowledging the correct inflation. But these are the numbers that Wall Street uses, remember. So for any gold bugs out there, that's something important that all of us should notice. We should look at the numbers that Wall Street's looking at, not what common sense is telling us. And now you have Paul Krugman, of all people, another academic. And he's praising Art Laffer because Art Laffer admitted that there's no inflation out there compared to what he thought there would be. So once again, you see all of these academics that use these phony baloney government numbers and come to the conclusion, hey, there's no inflation. But if you talk to the common man or the restaurant owner who is decreasing the portion sizes of the meal, they're telling us there's inflation. But these academics who use the numbers that the government provides and that are promoted by the mainstream media, they're telling us that there's no inflation. Who do you trust? A PhD living in an ivory tower, or a restaurant owner who's forced to make these tough decisions like giving their customers less product, right? Who do you believe? I would rather believe the common guy rather than these academics who are making fools of themselves by telling us there's no inflation. And once again, I have to mention, you have to see that the Austrian school, no one pays attention to those numbers for some odd reason. They're the ones that are right when it comes to this. And those that are trading, I guess the only thing to look at is what Wall Street looks at. And the Wall Street looks at phony baloney numbers cooked up by the US government. Or some private sector number, but that's not John Williams' number. So that's something to think about, guys. Anyways, I'll talk to you another time, guys. Thanks a lot. Bye.